Welcome back. Let's talk with David Nelson. He's at Belpointe Asset Management near New York City, and he'll talk to us about some of his thoughts on the current market, some of his picks as well. David, let's begin with the story that everybody's talking about again today, and that's renewed tariff threats from the U.S. administration to U.S. trading partners, including Canada. Where do you think this is going?
I think you have to distinguish between, tariff threats and tariff reality. I think you're going to find, even with this administration, that these are going to end up being surgical in the end. He's looking for reciprocity on a lot of things. And I think ultimately, as we get down the road, maybe towards the end of the year, there's going to be a lot more negotiation. You've already even seen Europe offer to lower tariffs. Some of the car companies over there, BMW in particular, has offered and said that the tariffs should go down from 10 to 2.5%, which is what the United States puts on them. I think that's going to be kind of the playbook that goes forward, and you're going to see a lot of discussions between the United States and Canada and the United States and Mexico and the rest of its trading partners.
Okay, in some recent commentary, you have said that dispersion in the stock market is off the charts this year, and one of the takeaways is you caution investors against the notion of plunging into anything that is not technology on the S&P 500. In other words, the so-called S&P 493. First of all, remind us what dispersion is, how it gets measured, and what does it mean that it is very high this year?
It's very high. I mean, just look within the Russell 1000, the 1,000 largest. The 1,000 largest by market cap. 20% of the Russell is up 10% year to date. That's quite large. This early in the year, we're only 5 weeks in, yet 30%, that's 300 stocks, are down year to date, and half of those are down more than the market is up. So the dispersion is pretty wide. A lot of strategists are telling their clients and or advisors that they should avoid the Mag 7 and pile into the other 493. I think you got to be more discriminating than that. I think you're going to have to pick and choose your places. Even within the Mag 7, it's obviously pretty nuanced. Most of them are struggling this year, but Meta's obviously having a very good year because they're the one AI hyperscaler that's getting a return on investment right now for the amount of capital they're pouring into AI.
And we're showing a chart now that speaks to something you just mentioned. That is a look at three major sectors of the U.S. stock market over the past year or so. The blue line is the tech sector. And indeed, as David has just said, it over the past year has actually underperformed the broader S&P 500, which is the white line, and the U.S. financials, which is the orange line on your screen. What do you think of the financials? They have indeed done very well. And you can even see it on our graph. They really picked up in November, the day after the election.
Yeah, financials are the leading sector right now year to date, and in another couple of weeks they could actually be the leading sector on a one-year basis. I think you're going to find that tech is probably somewhere around the S&P 500 on a trailing one-year basis. It is the worst performer year to date, but actually even there, this is where the dispersion comes in. That's because the indices are market cap weighted. You look within the tech sector, you're going to find a lot of stocks up strong double digits.
Okay, let's go to a couple of stocks you like. The first one is a financials. It's a payment processor, MasterCard, one of the giants of that sector. Why do you like MasterCard?
Well, start off right with the sector. We just talked about the strength of the sector, and if you look within that sector, you're going to find a lot of green. The banks, the credit card companies, a lot of new emerging financial stocks in there. But MasterCard, what I like about MasterCard, it's asset light. And what I mean by that is they don't take on any credit risk. And when we have an economic downturn, banks are going to be pretty hard hit. Credit card companies are going to be pretty hard hit. MasterCard will get through that because all you're looking for is the volume growth, the technology. They're also going to be a major beneficiary of AI as AI is used to decrease fraud detection. They're working very closely with Databricks on that. Okay, another one you like in a completely different sector, Darden Restaurants. Yeah, not every stock has to be a high-tech flyer, where you're hero zero on earnings. Take a look at this chart. You're going to see like four gaps higher in just the last year. It's got all my favorite, restaurants in there: Longhorn, Yard House, Capitol Grill. and you've seen these gaps higher, you can buy into a Starbucks trading at 37 times earnings, looking for a turnaround. This is a company that's already turned around, has very strong growth, and yet you're getting it for less than a market multiple. So I like this, and I also like the 3% dividend.
David Nelson, thanks a great deal, as always, for speaking with us.
Thank you.
He is Chief Strategist at Belpointe Asset Management.